What's going on, guys? Crypto Renegade here. In today's video, I'm going to be explaining the real risks of crypto leverage trading, something most people don't talk about. Let's get into it. But before I jump into the content, I just completely revamped my website, bitcoinlockup.com, as you can see here. There's some very exciting stuff coming, soon to be announced, and you can always preview my newest videos there before they hit YouTube or any other platform. There will also be some bonus exclusive content coming that I'm not going to make available anywhere else. It's time to upset the established order.
And here we go.
All right, guys, welcome back. Never invest money you cannot afford to lose. This is the golden rule of investment. Every seasoned trader will swear by this, and the concept of leveraged trading goes exactly against that. So, what is leveraged trading? Simply put, it is trading with more money than you actually have. In brief, it is basically carrying out a trade at a value that is many times your current collateral. Usually, this is called margin trading. For example, if you have a margin of, say, 30% and you want to make a trade worth $100,000, you have to pay around $30,000, while the rest of the amount, the other $70,000, would be covered by the broker. Similarly, if the margin is 20%, you have to pay just $20,000 for the same stock or commodity or whatever. Essentially, it means that your position is leveraged by a given factor. It also means that your gains or losses are amplified by the same extent. While the scope of higher gains makes it very lucrative and attractive, the risk of higher losses also makes it fatal, could wipe you out. This makes leverage trading similar to playing with fire. While the roots of leverage trading can be traced back to the traditional or legacy financial markets, its introduction in the crypto markets as early as 2013 has increased the risk by several fold. You've probably seen some other crypto YouTubers shilling Bybit or Femex leverage trading links on their channel. Trust me on this one, you won't find that here. I actually want to help you keep your crypto gains and not gamble it. Unlike in traditional markets where usually leverage of a 10x is provided, there are crypto platforms that have started to provide leverage of over 100x, with some sites like PrimeBit also raising it to 200x. Traders are also provided with the option of leverage to open both long and short positions. A long position is when you buy an asset at a lower price first and then sell it when that price rises in the future. Pretty simple. Similarly, a short position is when you sell an asset at a lower price first and then buy it when prices start to fall. So bets can be placed on a cryptocurrency's price going in either direction. While all this sounds incredibly lucrative, it is important to remember the difference between traditional or legacy markets and the crypto markets. They are two very different beasts. One of the most important differences is that, unlike traditional markets, crypto markets are completely unregulated. Some think that's good, some think that's bad. There's literally no middleman to check on who's doing what. So in that regard, platforms such as BitMEX and Binance began allowing users to trade with a margin of just 1%. It means with every trader could trade $1 and you can make up trades up to $100. The crypto market has a history of tremendous instability, and with the hyperinflation of the trades values by leveraging the margin value, the market volatility skyrocketed. So in the crypto market, a fluctuation of around 20% is a pretty common occurrence, with values falling up and down to 40% on its worst days. Such a lack of regulations also makes crypto markets extremely prone to price manipulations by whales. Watch out. There also have been instances of crypto exchange hacks, as well as exit scams and rug pulls. All of these things can lead to a severe loss of the trader without being your personal fault. If the trade is leveraged, such losses can be amplified by several times because of the greater risk. Another troubling factor is called forced liquidation. Liquidation is the process of converting assets to cash or cash equivalents. Owing to the high volatility, leveraged positions are automatically liquidated by market orders when the trader fails to fulfill the margin requirement. For example, if you start with $100 and you enter a leveraged long position in BTC market with a 10x leverage, it would be worth $1,000. So this $1,000 basically is comprised of your $100 and then borrowed $900. So what happens if the Bitcoin value falls by 10%? The position is now worth $900, and if the price falls further, the losses would have to be incurred by the lender. So the trader's position is automatically liquidated at the cost of its initial capital. So while the price may just fall 10%, he or she would still lose the entire capital you put in. So it is very important to understand that the amount of the fall in the value has little to do with the chances of a trader losing his or her entire capital. If you end up losing your shirt, just don't end up like this.
I suggest you stop whining like a little bitch and do what I say.
Recently, over $30 million in Bitcoin longs were liquidated within 24 hours, even though the price of Bitcoin fell by just 2%. Furthermore, there have also been instances of things going very wrong with forced liquidations. Back in 2018, a trader was liquidated on OKX for placing a $416 million bet using leveraged margin. It led to a shortfall of 1,200 Bitcoins being worth $9 million at the time, which was then socialized among the members of the platform, and the losses had to be paid for by other traders on the platform. Such instances of bills being footed by other people of the platform are not uncommon in traditional crypto marketplaces. So these are just a few of the risks of leverage trading in the crypto market. Not to scare you with all the downsides, if used correctly, leverage trading also does have some benefits. It amplifies the gains which could not be made on every single spot trade. However, with the incredible risks that it carries, it is best left to the more seasoned players of the crypto market. They have the required experience and knowledge of tools such as stop loss to carry out safer leverage trading. And of course, crypto YouTubers and influencers fail to point out this very important precaution to new traders who are lured in by lucrative captions and thumbnails of videos and posts telling them how they could earn tens of millions of dollars through leverage crypto trading. Why? Because they're financially incentivized by these companies, for example, Bybit and Femex, if you lose. I'm not joking on this one. They literally give zero if you get wrecked. It has caused major losses to several novice traders and has also even led to a rise in suicides. So while leveraged crypto trading is indeed a very high-risk gamble, there are some tips that you can follow for a safer margin trade. The first priority is a well-analyzed trading plan. It helps you plan out your trades consciously and helps you develop consistency. I talk about this a lot. Proper research and detailed layouts help you make a highly targeted development and eventually scale to regular profitability. Secondly, it is best to learn to use such tools such as stop loss and develop an in-depth understanding of the inner workings of the crypto market. The crypto market is an incredibly complex system that is prone to changes, bugs, hacks, and due to different factors ranging from a massive worldwide lockdown to something as simple as a tweet. Now, a simple idea is if you cannot make the money on simple spot trading, you definitely should not try your hand in leverage trading. Prove to yourself that you can enter and then exit a trade in profit. Seriously, you should practice extensively before you choose to dabble in leverage crypto trading. And last but not least, avoid being overly optimistic or enthusiastic. While dealing in highly volatile markets such as crypto, it is important to remember the golden rule of investment. Never invest money you can't afford to lose. So, be smart and trade with an amount of money that you can actually afford to lose and not lose your rent or your groceries or your living expenses. And another strategy is to avoid placing more than 5% of your account value per trade. In the case of extremely volatile assets, utilize the thumb rule of risking 1 to 2% of your trading capital per trade to limit losses. Most importantly, avoid overtrading in an attempt to multiply your gains or make up for your losses. Gains and losses are a part of trading, and it is important to always know when to stop. It's more about self-analysis. Though traders can indeed profit massively from opening several positions at once, the losses can be equally devastating. These are some of the measures that may help you trade more safely and more effectively. So, these are some of the real risks of crypto leverage trading that most crypto YouTubers will probably never ever tell you about. Crypto leverage trading is just like playing with fire. You better be careful. And if you aren't experienced enough, chances are you'd most likely burn yourself very badly if you put more than you could afford. So if you're new to the crypto market, it is best that you do not play with this fire. It's very complex. The safest way to foray into the field of leverage crypto trading is with caution and extensive experience in demo environments. So let me ask you, have you ever tried leverage crypto trading?
Watch, it will pay. I may have been early, but I'm not wrong.
And if you have, what was your experience like? Has anyone here fallen prey to the false promises of other crypto YouTubers that shall not be named? Let me know in the comments down below. And then I'll see you guys in my next video on your screen here to see if the Bitcoin super cycle in 2022 will play out this year on your screen. I will meet you guys in that video right now. Crypto Renegade out.